You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Tuesday, everyone. This is the last day of November, and I feel like I deprived you this year, and I apologize. Please know it was inadvertent. The month of November is always supposed to be about Nerdvember, which means lots of nerdier material when it comes to our podcast and screencasts. But I came down with the worst cold, and maybe it's because we were all quarantined and staying away from each other for so long, but this cold hit me hard earlier this month, and I didn't have much of a voice for podcasting or recording anything that you would have wanted to watch or listen to anyway. So today I'm trying to make up for lost time, and I apologize, but the last podcast we recorded went out more than 2 weeks ago at this point. The title of the podcast was How to Buy High-Growth Stocks Using Relative Strength. And in that podcast, we not only defined what a high-growth stock is, but we also went over a bunch of different ways to scan and screen for high-growth stocks. So if you want to go check that podcast out or the screencast, you can do so on either iTunes or YouTube. And by the way, watching or listening to that is not a prerequisite for this podcast, by the way. I just think that if you are somebody who really enjoys this nerdier stuff and you really want to understand relative strength in its totality, I think it would make a lot of sense to watch and or listen to both that podcast as well as this one. But with that being said, there was one big method of screening that I left out last time, and it's something called relative rotation graphs. And I left it out on purpose because it would have taken an entire podcast or screencast episode just to explain this one concept. And please keep in mind, it's not complicated, so I don't want that to scare you away. In fact, it's one of the easiest ways to understand relative strength because of how visually appealing it is. The only catch is, while I'll do my very best to explain it through words, the relative rotation graph, or we're just going to call it an RRG for short, just so much faster to say, but the RRG is a very, very visual, and thus, I'd recommend heading over to our website at libertaswealth.com if you're somebody who's listening to this today on iTunes, and I would click on the education tab, then I would click on the Cash Podcast videos, and on that link you'll be able to watch along with me as I go through everything here, as opposed to just listening to it, because it is going to be, like I said, very, very visual, and so I think the visuals will help, but I'll do my best. So let's go ahead and get this show on the road. Before we do so, as always, a few housekeeping items. First off, thank you so much for joining us. As always, my hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and above all, more educated than you were before you started listening today. So come back often and subscribe. These episodes appear both on iTunes and YouTube. And you can also follow me on Twitter at Adam Koch and on Instagram at Financial Surgeon. Last but not least, I always say that all links, visuals, charts, all educational material, other resources we have available for you, they're always on our website at libertaswealth.com. And like I said earlier, this is going to be a very visual episode. So I think that I'd highly recommend checking out the video in addition to the audio podcast if you're just listening today, at least for starters. So let's go ahead and get started. We're talking about rotation here, rotating into investment success, using the title on purpose because relative rotation graphs, or RRGs for short, are all about rotation. It's asset class rotation, it's sector rotation, industry group rotation. It's the rotation of stocks out of strength into weakness, into lagging, back into improving, into strength again. Julius de Campanera, somebody I'm proud to call a good friend, he invented this concept. I wish he'd tell me how he built it, but he won't. And I don't think he ever will, but that's okay because I get to use it, and that's what's most important. But Julius invented this concept, and before I explain it to you, I want to start with a quote. And this is so important, and it's applicable today. Really, it's applicable to all investing. But John Maynard Keynes, an English economist, said, when the facts change, I change my mind. And what I think most people don't realize about when it comes to investing, the facts change a lot. Things change all the time. Now, of course, everybody's time frame is different. Some people, when they're investing, they're looking at things on a day-to-day basis. Some people are looking at things weekly. Some people are looking out, say, 3 to 6 months. That's more my time frame when it comes to our trend-following models. We have 4 trend-following models, and that's intermediate term based. So that's our time frame is intermediate term, which again is about 3 to 6 months out, maybe a little further depending on the analysis I'm using. And then some people are much, much longer term in nature, and these would be the buy and hold type portfolios, things like strategic models. We have 5 strategic models here that stay in the market all the time. Now, case in point, as we look at these relative rotation graphs here, even a buy and hold portfolio, a strategic portfolio, even though it's going to stay in the market, when the market is going down, what's in the portfolio is going to change because the rotation of what was strong yesterday becomes weak as time goes on through that rotational process. In fact, as the market starts to go down, and we start to rotate someday into a more bearish environment, into an environment that's more that looks like, let's just say we're in for a big market crash, a bear market that lasts, not just 3 or 4 months, but we're talking one like we saw in 2007, 8, and 9, or 2000, 2001, 2002. So something bigger like that. What we start to see is we start to see a rotation out of offensive names. In other words, the offense kind of comes off the field, and things like technology and AI and robotics and a lot of the tech-heavy names start to struggle, and the stuff that you start to see rotate into strength and start to improve are things like high dividend payers, blue chips, real estate, utilities, and other defensive names. So in other words, the defense kind of comes onto the field. Now, when you're in a buy and hold portfolio, when you're in a strategic portfolio and you're using that rotation, that asset class rotation, sector rotation, industry rotation, you're going to get the rotation, but when everything's going down on a relative basis, you should perform better. In other words, the stuff that's tech-heavy is going to perform worse than the stuff that's more defensive. So offensive names aren't going to perform as well as defensive names. But what's also going to happen is on an absolute basis, everything's probably going to go down for the most part. When I say everything, I don't mean literally everything. But when I look back to, say, 2009 in March, at that point, when you look at, say, I'm just going to quote a point and figure statistic that I memorized years ago, so I'm going to use that because I know it, and I know it to be fact. But in 2009, in March, only 4% of stocks in the U.S. were trading on a point and figure uptrend. In other words, 96% of stocks were in a downtrend. So is everything going down? No, not everything's going down. So there's usually something that's going up. But the problem is that when the overall market starts to crash, when the overall market really struggles, what happens is that it's like trying to swim against the stream, trying to pick that small percentage of stocks or bonds even, or commodities, it doesn't really matter what, international stocks that are doing well. Instead, it's best to just swim with the stream and try not to go against the grain. So, 4 out of 5 stocks move with the market. So if you're trying to go against that trend, it's probably going to be a whole lot more difficult than you probably care to deal with. So the point here, again, with John Maynard Keynes' quote is, when the facts change, I change my mind. There's nothing wrong with changing your mind. Or in fact, as one of my other mentors, my earlier mentors once said to me, there's nothing wrong with being wrong. And you just can't stay wrong. In fact, show me somebody in investing who's been right all the time, and I'll pay them as much as they want to manage my portfolio and everybody who hires us. But there's just no such thing. This is not an easy job to pick investments, and as things change, we have to change our mind, we have to change what we're invested in, and we have to adapt to the environment that we're faced with. So relative rotation graphs are a really, really good way to do that and to visualize it. It's very simple for even a 5th grader could really, really understand how this stuff works. In fact, my kids are in 6th grade and 2nd grade, and they understand this after being explained. So let's jump into it. I'm not going to have a bunch of slides today. Instead, I'm just going to take you into Optima, one of the pieces of software that I rely heavily on when doing my analysis. And before I even get into how what all these things are. You're looking at all these arrows and different colors and the circle in the middle. Let me just explain what you're looking at here. So this is a relative rotation graph. Again, invented by Julius de Campanier, became popular, I'd say about 10 years ago, I think it was. It was introduced to Bloomberg, and then it became even more popular. About 5 years ago, we started seeing it on places like stockcharts.com in the mid 20-teens and so on. And now you can I think you can find it on almost any major software program, even for free. At stockcharts.com, for instance, you can pull up an RRG for free and punch in some information without even having a login. So anyway, a relative rotation graph visualizes the rotation of strength over time. And what you're looking at here is a quadrant graph. Now, the upper left-hand quadrant is improving versus the market. The upper right-hand quadrant is beating the market. In other words, leading the market, or leading in strength. The bottom right quadrant is weakening versus the market, so it's starting to weaken. And then the bottom left-hand quadrant is lagging the market. In other words, that's the worst place you can be, is basically just underperforming the market dramatically. When I say improving versus the market, leading versus the market, weakening versus the market, where's the market? Well, the market's in the middle here. So what I've done is I've put the S&P 500, the SPX, at the 0 point on the XY axis, because that's what I want to be my benchmark. And by the way, this is such fascinating stuff that if you wanted to see, and I have, not on this workbook here, but I have RRGs for bonds. So if I wanted to put the AGG, the bond index, as my benchmark, and then plot bonds around on the RRG, I can do that as well. I can do it with commodities, where I can use, say, the DBC or just a commodity index, and then put different commodities like platinum, silver, gold, palladium, gasoline, hogs, orange juice, oats. So I can use that RRGs for really any investment. You just have to choose what the appropriate benchmark is. You can do international stocks. You can use what's called the All Country World Index, XUS. So in other words, it's all countries overseas, and it takes out the United States stock market, and then you can compare that to international stocks and use an RRG for that as well. So before I go too far, that's how this works. So what we're doing here is the 0 point on the XY axis, and the very, very middle is the S&P 500, and then all the stocks around it are individual stocks on the S&P 500 in this case. So in other words, I'm taking all 505 stocks and I threw them on this chart. And what you're actually looking at is not all 505. What you're looking at is something that I built and had coded into the software that shows me all of the stocks on the S&P 500 that are pointing northeast toward the leading quadrant. And that's because that's what I want to focus on. I want to focus on the ones that are heading northeast, or heading toward improving and or leading. Now, if I start over here and I start with a plain RRG with no coding whatsoever, I'm going to click on it and you can see how it gets built here. So this is building all 505 stocks with RRG. It's going to be done in a couple seconds. And then boom. Now we have everything. Now you can see this list looks like a total mess. And now you can probably see why it is that I like to code and filter out the stuff I'm not interested in, is because look at all that messiness. It's almost like a bunch of spaghetti. Probably not spaghetti you'd want to eat, because I don't think that's the color spaghetti should be. But let me turn off this multiplier real quick here. I'm going to make it 0. There we go. So when I get rid of that multiplier, and I'll explain what that is in a second, you can see every individual stock on the S&P 500 in this RRG. If we wanted to get really crazy, which we don't, and I won't, I could take the Russell 2000, which is 2,000 stocks instead of 505, and I could plot the Russell 2000 in the middle as the benchmark, and then put all 2,000 stocks on the Russell 2000 on this RRG. It would take a little bit longer to load. Maybe instead of 8 seconds, maybe it would take something like 20 seconds to load, but I would have every stock, and I could compare that to how the Russell's doing. Of course, the reason I say I wouldn't do that is because most people don't use the Russell as the benchmark. First of all, most people use the Dow or the S&P. I prefer the S&P or the NASDAQ, because the Dow only includes 30 stocks, and they're all large company stocks. The S&P is 505 stocks, but it's cap weighted, which means that the biggest stocks are what matter the most, and the small ones don't matter as much. And then the NASDAQ, which is also cap weighted, is more tech heavy. So it's kind of more, I would call it a modern index, if you will. But anyway, I'm going to zoom in here, and let's point out a couple positions. So right now, Dollar Tree. You can see here, Dollar Tree is in the upper right-hand quadrant, the leading quadrant. And what that means to us is that it's leading the market. It's beating the market. So this is a weekly chart. So I'm going to pull up a weekly individual chart and go to Dollar Tree. And you can see here that most recently, Dollar Tree has been doing very well. In fact, this is today, the new week. 1, 2, 3, 4, 5, 6, 7, 8, 9. So it's 9 weeks off its bottom, which means about 2.5 months it's been going up. Now, there's no way to pick the bottom, right? That's impossible. But I'm curious. This is October 1st. Let's see where Dollar Tree was on October 1st. And all I have to do is rewind this, by the way. So here's the date in the upper left-hand corner. Well, not really the corner, but this is 12/3. So I'm going to back this up to 10/1, and we're going to find Dollar Tree. Where are you, Dollar Tree? Where are you? Should have followed it. Let's see. There you. Okay. You can see it in the right here. I'm going to back up and try to follow it. 2, 3. Oh, I lost it again. This is 11/5. I think I see it. This is 10/15. There it is, Dollar Tree. Oop, got zoomed in a little too much there. There we are. Okay, so there's Dollar Tree. I'm going to zoom out a little bit more because I know I'm going to go backwards one more week. And by the way, this is all on the fly. I did not look this up in advance. So this is just as interesting to me as it is to you, hopefully, right now. But there's Dollar Tree. Dollar Tree was pointing northeast, heading toward the improving quadrant. Now, if I back up, you can kind of keep your eye on it there. Dollar Tree was pointing northeast, coming out of the lagging quadrant, pointing into the improving quadrant on 10/1. Now, for me, anyway, that's one of my favorite places to buy a stock or an ETF on an RRG is when it's in the lagging quadrant. So it's already been beat up, but it's starting to rotate into improving. And then from there, I also like to filter, and I like for it to be above the 10-week moving average. So if we look at this chart again, you can see here on 11/1, huge day for Dollar Tree, by the way. Let me see here. What's the performance that week? We went from, it was up almost, 16% on just that 1 week. So let me delete that there. So it 16% up in 1 week. People might say, oh, I don't want to buy that because it went up 16%. I'd be buying at the high. Well, it bounced above this 10-week moving average right here. Let me turn off the crosshairs. So it came above the 10-week moving average. You could have waited until the following. You can see how it behaved. But now you're buying above a flat and eventually rising 10-week moving average. And again, as we saw, as time went on here, let me back up. As time went on, we saw Dollar Tree start shooting northward, and now it's leading the market and doing so very handedly. Here's another one over here, Enphase Energy. Let's look at, I wasn't going to look at Enphase. Well, Enphase is a good one. Let's look at Enphase. So ENPH, Enphase Energy. And by the way, these are color-coded. These are called relative rotation candlesticks. I've coded them for me because I'm colorblind. I'm full spectrum colorblind, so I have a really hard time differentiating between yellow and red and green and fluorescent green and yellow and darker colors like purple I don't see at all. So I coded these all to my own colors so I could tell the difference between where they are on the RRG, all depending on what the charts tell me. So here we can see this is blue, so it's in the improving quadrant here, but then it kind of started to fail. And then here it's in the, let's see here. So now we're starting to see it heat up, right? And then as it improves and heads into the leading quadrant, now it's red, which I think it's red anyway. At least I shouldn't say that on a recording because I might just eat my words here. I didn't ask anybody to come in earlier today and take a look at my colors to make sure that they were accurate. But it doesn't matter. As long as I can tell them apart, that's all that matters to me. But anyway, you can see here how it's really started to do very well over the last several weeks. 1, 2, 3, 4, 5, 6, 7 weeks. It's been above its 10-week moving average, not only rising, but if we look here, I can draw a line and show you that the most recent highs right here from back in January and February of 2021, it's not only exceeded those highs, but that's where the 10-week moving average resides now, is at those same places, those highs from earlier this year, which is great. That just provides more, for me, it provides more evidence that, this is a good former place of resistance. In other words, a ceiling that was previously above our heads. We broke through that ceiling here on the week of October 29th, and now we're holding above that ceiling, which is now going to become a new floor of support potentially below our feet. So kind of like think of it like a floor, and if it breaks through the floor, that's not good. But it's also that floor of support's also at the same point that the 10-week moving average is, which is a place that above which institutions, big money, smart money, likes to accumulate assets. When you see a stock or an investment go below the 10-week, especially if it goes below the 10-week on high volume, which isn't on this chart, by the way, then that's usually an indication that the big smart money institutions are not interested in owning it anymore. In fact, they're hitting the sell button pretty quickly. So that's what an RRG looks like, just a normal RRG. Now, the other thing that let me put the standard deviation multiplier back on here. What I have on here, this circle, this is 2 standard deviations from center. And I know this is probably going too far, so I'm going to keep it super quick. The reason I'm using a standard deviation multiplier, a filter, if you will, is because I really don't care about the stocks that are within 2 standard deviations of the center when I'm looking at all the stocks in the S&P 500. I'm more interested in the ones that are outside center. And the reason for that is because the further outside the center they are, then the higher the probability that we're going to get better growth out of those stocks. If you're buying stuff that's really close to center, you're buying stuff that's performing very close to the market, right? Because the market's in the middle. Whereas the further out you go, you get more potential outperformance when you buy stocks that are further away from center. But what you also get is more volatility. So that's what you have to keep in mind as well, is you have to, whatever you're buying, you have to do more than just look at, you can't just look at Wynn, like Wynn Las Vegas, which is the, Encore and Wynn hotels, the casinos in Las Vegas. You can't just look at this and say, oh, Wynn, it's in the improving quadrant, pointing northeast, I think I'll buy it. It really takes a little bit more analysis than that to determine whether or not it really makes sense. So if I look at Wynn and I pull up a chart, and again, I did not plan this in advance at all. It's interesting. But you can see here that on a weekly chart that this RRG is actually heading down. It's below its 10-week moving average. This is not one I would want to touch. I like to buy stocks, ideally, that are above their 10-week moving average with some exceptions. An exception might be if it starts to really kind of base sideways and chop around and kind of creepy crawl sideways, but it's doing so above this level of previous support. So these two lows right here. So anyway, so you can. I've been showing you weekly charts, which is what I mainly use because I don't want to be too fast to make changes when I don't think it's necessary to do so. But you can also look at RRGs on a daily basis. So as opposed to every tick on this chart, every dot right here is 1 week. Let's turn off the crosshair again. So this is 1 week. That's 1 week. That's 1 week. That's 1 week, and so on. Instead, we can change that so it's on a daily basis. So here, it's going to load for a second, is an RRG, but it's every tick that we move is a daily chart. So again, we got the same mess of spaghetti that we had before, but when we look at this chart, it's much, much, much faster because we're not looking at the movement over periods of weeks. We're looking at the movement over periods of days. In fact, if I go backwards here, and I want to show you this, so I'm going to go to the beginning of 2021. So watch as I go slowly at how these stocks rotate. And if you don't find this fascinating, at least a little bit, even if you don't care about the stock market, even if this financial stuff just bores you to tears, even if the idea of opening your portfolio and trying to understand the investments you own makes no sense at all. This visual right here is so cool because what you're witnessing right now, or what you just witnessed, and I'll do it again on the weekly chart to show you that it's fractal, meaning that fractal means it works on all time frames. But what you just witnessed is that relative strength exists, and what I just showed you is proof that it exists, that there is a rotation that occurs in the market where not just individual stocks, but asset classes, industry groups, sectors, they rotate in and out of favor over time. Now, it's not perfect. When you look at the statistics, technically, the rotation, it moves from quadrant to quadrant clockwise about 70 to 71% of the time. But statistically speaking, that is incredibly significant, which means that Julius found something, well, he didn't find something, he created something that's quite a phenomenal gem here in the world of technical analysis, stock research, and really investment research as a whole. So I just showed you this daily chart going back. I'm going to show you the weekly. So let's go back to the weekly. I'm going to do the exact same thing I just did, except I'm going to go back, let's go back 5 years. I'm going to go all the way back to 2016. So 2016, this is a weekly chart, okay? Now watch as time goes on. You can see, and by the way, the reason the standard deviation is changing is because the distance from center, when you look at all the stocks and you average them out, the distance from center is changing on average, so the standard deviation multiplier changes. But as time goes on, I'm going to zoom out a little bit here. There we go. Who's all the way, look at M phase all the way down there, 2018. This keeps rotating for the most part clockwise, right? So the reason I'm silent right now, for those of you that are listening on iTunes, is because I'm just letting this thing rotate back and forth. The reason I stopped and rewound, by the way, is I'm not tinkering, but I want to show you how crazy things got during COVID. So we got normal rotation from 2016, rotation, clockwise rotation for the most part, right? Clockwise rotation just keeps going. Here we are through mid-2019. We've got rotation Western Digital's in the leading quadrant. We've got Tesla in the leading quadrant, State Street in the leading quadrant, Fortinet, Align Technologies, which is Invisalign. Now in the beginning of 2020, things start to change. This is 228. This was the very top of the market, or at least the week the market topped in February of 2020. And watch what happens to the stocks. Boom. We get a very huge distinction between what's weak and what's strong. If we focus first on what's strong, some of it's going to be pretty obvious to you now in hindsight. Clorox, Regeneron Pharmaceuticals, Netflix, NVIDIA, so semiconductors, AMD, Citrix, which is technology. There's a lot of security software. We use Citrix for our secure file sharing. Kind of funny. Domino's Pizza. Pizza places did not struggle during COVID. Dollar Tree, or Dollar General. Let's see what else is here. I'll keep rotating. Insight Genomics, Etsy, people buying things online, Newmont, Eli Lilly. So those are the things that were doing well. Now, if I go down to the other end, this other extreme, an extreme it definitely is, Caesars Entertainment, like Caesars Palace, Royal Caribbean, Carnival Cruise Lines, Occidental, United Airlines, Halliburton, Penn National Gaming, American Airlines, MGM, again, casino stuff. So a lot of the stuff that was struggling, here's some retail, Under Armour. So Under Armour's retail clothing, which is doing fine now, because now I don't think anybody wears suits anymore. I think everybody just wears athleisure. I can't remember the last time I wore a suit, but of course I might wear a suit if I fit into one. Thanks a lot, COVID, by the way. But anyway, you can see as time goes on, now COVID starts to find its way back to some kind of normalcy. And then as we are, where are we now? We're in August of 2020. The economy's starting to open up again. And the stuff that's doing well now is Caesars, MGM, FedEx, Generac. The Generac's a company that does the whole house home generators. People were spending money on things like that, not only because new homes were being built and they people wanted to put generators in their homes, but also because people that didn't have generators before weren't traveling, they weren't going anywhere on vacation, so they thought, you know what, why not put a generator in my house so the next time we have a storm, I don't lose electricity. So now they have generators. But anyway, as time goes on here, you can see we hit the end of 2020. We head into 2021, and that rotation just continues. And where we are right now, again, as we kind of finish where we started today, is we're looking at Tesla in the leading quadrant, but starting to head south. So we're starting to see it weaken on a weekly basis, on a longer-term basis, call it intermediate-term basis. AMD, and NVIDIA, both semiconductor stocks are doing very well, and they've continued to do well, by the way. We see Ford is doing really, really well, Enphase, and so on. So when I go back to my little code here, my little cheater code that I created, this is a code that shows me all the stocks that are pointing northeast. And what I see when I go to the bottom left-hand quadrant, which is where I want to spend my time when I'm looking for new stocks, because I don't want to buy them when they've already been leading. I don't want to buy them when they've already gone up, call it 10, 20, 30%. I want to buy them when they're starting to emerge from the lagging quadrant and start to show some promise that perhaps maybe they're doing okay. So let's look at a couple of those just to do some further analysis. Because again, remember earlier I said when, even though it's in the improving quadrant right now, I don't know if it's something I would buy, and I had no idea until I pulled up a chart. But let's look at Western Digital, so WDC. Oops, that's WDS. So Western Digital, yeah, that actually doesn't look that bad. We've got kind of a nice bottoming pattern starting to show here, where you've got a nice rounded bottom. The last couple weeks, it's been in the improving quadrant, which is why it's blue. And we have, I think it's blue anyway. And then we have, it came above the 10-week moving average last week. It's back, it's still above it this week. So this is something that I would probably put on a watch list in a different piece of software. And then I would kind of start comparing that watch list to other things that I have. So let's look at another one. Let's see here, Newmont. This is going to be gold mining. So Newmont Corp. I'm not a fan. It's kind of chopping sideways. If this thing were to head back above its 10-week, then I might be interested in analyzing it a little bit further, but I'm not interested in it because as long as it's below the 10-week, it's just one of the filters that I prefer to use. So, I'm just not going to be interested in it. So Pulte Group here, right here in Columbus, Ohio. PHM, I think, is the symbol. Yeah. This is the old Dominion Homes purchased by Pulte years ago. And you can see here that Pulte Homes it's above its 10-week, kind of sideways, but at the same time, while it's sideways, if you remember last week on Friday, the market did very poorly. Big, huge drop. Dow was down about 900 points. Let's see, today it looks like the S&P was up about 1.3%. NASDAQ was up 1.9%, and I think the Dow was up around 300 points, something like that. I was just looking over at my TV. But it kind of held in there, so this might be something I would throw on my watch list. What else do we have here? Ross Stores. I swear I see Ross Stores on my screen all the time. Yeah, not a huge fan. One of my early mentors said to me, and I have a lot of mentors that I've taken on over the last 2 decades, but he said to me that when you're looking at stocks, or anything for that matter, any investment, you should be able to put your hand over the name and not care what it is, and just look at the chart and analyze what's going on from the standpoint of price behavior, trend, volume, momentum, and you should make your decision based on that, not on what the investment is. So Ross Stores in this case, obviously discount retail, not something I'd be interested in even normally. This is a stock we've owned in the past. We've made money on this stock in the past. I think we probably lost on a trade or two from time to time, but this is one that kind of seems to pop up over and over again over the years. MHK, so Mohawk Industries. Let's look at Mohawk, MHK. You can see here that 1, 2, 3, 4, 5, because I've got a 5-week. Where's the back test here? 1 week last year. The tails. Oh, here we go. So the tails, I have the tails set for 5 weeks. So the tail of these things, I can make them longer or shorter. So if I went over to tails and changed the tails to make them longer, I could make it really long or really short. But I just use 5 because it's enough, but not too much. But Mohawk's been kind of coming around here, and because the dots are so close together, that indicates that the momentum isn't very strong. But let's look at Mohawk anyway, just for fun. That's a daily chart. MHK. Yeah, Mohawk's there's just not enough strength there, not enough momentum. Still kind of declining below its 10-week moving average. So, nothing there I'd be really all that interested in. Cat. So Caterpillar. Let's see what Cat looks like. Nah, looks okay. It's below its 10-week, but it looks like it's trying to get back above. Again, it looks like this stock's trying to bottom. But I don't know. I think there's probably other things we could buy that would look better. Is that Skyworks right there? So Skyworks. No, it's Stanley Black & Decker. Sorry. Skyworks is SWKS. Stanley Black & Decker is SWK. So Black & Decker, again, looks a lot like the prior chart we just looked at. So Mohawk looks very similar. I'm not super excited about it, but this is something that, low risk trade. You could invest in something like this, and you could use that 10-week, like a decisive drop below that 10-week as your stop loss. You could say, if it goes below that on high volume, then I'm out. Then your maximum loss could be something like, 3-4% is all. And that's the name of the game, by the way, is trying to get good entries where your losses are as small as humanly possible, and then holding on to the gains as things start to run. Las Vegas Sands, just because it's way up here, I'm going to look at it, and then maybe this will be the last one we look at. LVS. So, no. The only reason I would even consider this one is, again, the first thing I saw is, big, huge candles, which tells me there's a lot of volatility, or at least more volatility, big price movements throughout the week, because the top of this candle is the end of the week, the bottom is the beginning of the week. The wicks are how high or low it got throughout the week. So if it's a hollow, empty candle, think it's light, it went up. If it's a solid candle, that means it's heavy. That means it opened up top and closed down. That's how you read a candlestick chart. So when they're hollow, that means it closed at the lower end of the candle at the end of the week, or day for that matter. And if it's empty, if it's a hollow candle, that means it opened at the bottom and closed high. So the easiest way to remember that is that when they're solid, that means they're filled up, they're heavy, and that they closed down, it was a negative. And if they're empty and hollow, that means they went up that week. But anyway, so that's the first thing I see. And the second thing I see, though, is, I see kind of an intra-week low here in August. I see several lows around the same point in September and October. I see the same kind of thing starting to happen here, where we're starting to close in on those lows from October and August. And then I go all the way back to the bottom of COVID, and I see an intra-week bottom that kind of sliced below this level, but obviously closed above here in March 20th, went sideways, went down, but never got below those levels again. So if you draw your eyes from the left of the bottom closing week, so this is the lowest point at the end of the week right here, is the bottom of that candle. This wick just says the intra week, it went down as low as, call it 33. But this is the lowest point right here, this solid candlestick at the end of the week on Friday. And you can see, if you draw your eyes over here to the right, it's kind of bottoming at that same point. So what you could do, if you were more of an aggressive trader, if you wanted to take a little bit more risk, is you might look at something like this as a potential buy, and you might use this intra-week low or the closing low, which would be around 36.75, something like that, 36.80 would be your stop loss, which would mean you'd have a very small loss if this thing, unless this thing gapped down, unless it just opened up 20% down the next day. And that's where you'd have to look into earnings and things like that. I'm going to pull it up on another screen here. Las Vegas Sands, earnings are already out. Well, actually, let me check something. Come on, chart. All right. It's 127, so let me bring it over to my screen here. So here, earnings are due, bottom right, on 127, so January 27th. So there's lots of time till earnings. There's not going to be I shouldn't say there's not going to be some crazy news that comes out that makes this thing go crazy or gap down, but that would be something I would be looking for, is that, if I were to look to take a high-risk investment like that, which I usually don't, by the way, then I'd be looking for when earnings come out or some catalyst that might cause it to go down fast. Otherwise, your stop loss could be somewhere around those lows there. All right. I think I've been talking for a long time, so I don't want to go too far here, but I do want to show you one more thing. I'm going to go over to another, let's see, ETF research. I'm going to go over to another workbook I have. And this one, these are RRGs as well, but these are ETFs. So this is kind of a mess. But you can see here, this is an inventory of ETFs. The inventory is here on the left. So it's everything from genomics to robotics to gold mining stocks to insurance stocks, medical devices, aerospace, high dividend payers, energy, steel, semiconductors, media, biotech. Everything's in here. I've done a correlation analysis to make sure I have every piece of the market I could possibly want, barring anything crazy. But or really, really ultra unique and new. I like to see things have some history before I'd even consider buying them. But when you look at this chart, it's actually kind of messy. When you look at this, this is the middle of the chart. Is the 0 point is the S&P 500. That's our index. And then when you look at everything around it and how things are performing, the stuff that's leading right now are blockchain, oil exploration, uranium stocks, lithium stocks, like the stuff they used to make batteries for electric vehicles and things of that nature. Semiconductors are pointing northeast in the leading quadrant here. Small cap energy, that's PSCE, that's small cap energy stocks. And things like regional banks. Regional banks they're in the leading quadrant, but they're starting to weaken. They're pointing southeast, which is not horrible, it's just not optimal. Lithium is in the weakening quadrant, but you can see how close together these dots are. What that's telling us is that it's just been kind of squatting around down here in the weakening quadrant, not really with any real directional momentum at all. So what we'd like to see here, if we own lithium stocks, which we do at our office, in our clients' portfolios, we would want to see this start to jackknife northward and head back into the leading quadrant, which happens a lot. In fact, if you don't own an investment as a B plan, another good signal to use as a potential buy candidate would be something that jackknifes and heads back into leading when it was coming out of the leading quadrant, something in the weakening quadrant that heads back into leading again. So that's U.S. stocks. I mentioned international stocks, so I'll show you that here real quick. This is international stocks. The center point is I put the S&P 500. That should be the ACWY. ACWY. There we go. We back up. Close you. Okay, so now our center point on the XY axis is the All-Country World Index. And what we have here in the leading quadrant, but declining, is Indonesia, so the Indonesian stock index. Peru is kind of improving but heading southeast, which isn't ideal. We've got UAE, so United Arab Emirates. Their stock market is in the leading quadrant, but very, very tight. It's kind of super, super slow here. But you can see there's a lot of things that are heading out of that leading quadrant. India, small caps, Argentina, Poland, Ireland. So a lot of these international stocks are heading, as compared to their index, the benchmark, are heading southwest into that lagging quadrant and are kind of no touches, things we wouldn't want to touch. In fact, let's see if I can find a chart here I can show you. So let's look at, here's Argentina. Let's look at Ireland, EIRL. So here's what it looks like on a chart. You can see here, had been doing really, really well for a while, spent a little bit of time below the 10-week, a couple times here, and then just kind of started to fail. So if we look at the performance off its high right now, we'd be looking at a drop as of today of somewhere around 14-15%. We can also look at commodities, though. I mentioned commodities earlier. Let's use the DBC as the benchmark. So here's the DBC. Now the stuff that's starting to improve are silver. Palladium is over here starting to improve. I think I see coffee in there. Yep. There's coffee, gold, lumber, which is WOOD is the symbol, which is funny. Palladium is improving. So let's look at a couple of these just for fun. So the one I like the most, just being honest. Right here, and again, I hadn't pulled this up until I actually hit record today, is palladium. So let's look at palladium. Go PALL. That does not look good. I thought it was going to look a lot better than it did, but it does not look good. So let me check something here. Let's look at this commodities chart. Is this a daily or a weekly? It's a weekly. Okay. I'm surprised. I'm surprised it looks as bad as it does. But I guess when you compare it, not to the stock market, but when you compare it to the commodities index, palladium is coming out of the lagging quadrant pointing northeast, but it's just the volatility is way out here on the left. So I guess that makes sense. But I was kind of hoping we'd see a better chart there, but we just don't. So let's look at another position like silver and platinum. So SLV, you can see here. Here's a low back here. Here's another low. Here's another low just a few weeks ago. Call it what was that? October 8th was the most recent low, close to it, September 24th, and it's kind of trying to toy with that low again. The question is, are we going to see lower highs and lower lows, or is it going to hold this line in the sand that dates back to the lows of December 4th, 2020, and head higher from here? And we don't know. And I guess that's maybe a good way to close out today, is that none of this stuff is predictive. In fact, there's a quote in my conference room on the whiteboard that says, predictions especially difficult, especially when it's about the future, because all of this stuff can help us stack the deck in our favor, because that's what we're trying to do. We're trying to stack the deck in our favor as best as we can, and then under normal market conditions, and the market's not always normal, but under normal market conditions, more times than not, as long as we've stacked the deck in our favor, things are going to work. And over time, not all the time, but over time, we should make money and keep our losses relatively small, and especially in a tactical portfolio model, which means trend-following portfolio model. When the markets crash, we should be able to sidestep a good chunk of the downside. In a strategic buy and hold model, we're not going to sidestep the downside. Instead, we're just going to own different stuff. I always like to say it's the cleanest dirty laundry, because while, again, on a relative basis, the investments we own may be going down, and we may be performing better, because the other stuff's going down faster, let's just say, that's on an absolute basis, it's still going down. So when markets crash, typically almost everything crashes. You might own something that's doing better and not going down as fast, but again, it's still dirty laundry. It's just the cleanest dirty laundry. So that's a good, I think, session on relative rotation graphs, how they work, how to analyze them. I showed you U.S. stocks. I showed you how to analyze the RRG itself, and then how to look into going deeper into the weeds with looking at a chart, and how to not just pick something just because it looks good on the RRG, but to dig deeper and look at some other analysis. We could go further, by the way, and we could look at things like relative strength index, like RSI. We could look at support and resistance levels. We could look at classical chart patterns. We're not going to do that today because that's going to go way beyond the scope of what I was trying to accomplish. We could look at bonds, which I'll just briefly say, here's the bond index. Now, bonds have been a mess, and it's been a really tough bond market for 18 months or so, especially through COVID and thereafter. But right now, we just have stuff that's, here's international corporate bonds, world inflation protected bonds. Here's sovereign debt, so overseas, again, a lot of international stuff. And then down here in the bottom right, we've got zero coupon bonds, so 25-year treasuries, 20-year treasuries, long-term corporates. So a lot of the bond stuff's like either weakening, lagging, or it's heading toward lagging. And the only way to really try to make something of this bond market, at least for me, has been to kind of go back and forth between owning bonds when they look strong and then shorting them, trying to profit when they're going down, as opposed to just buying and holding bonds. Because, as you may or may not know, when interest rates go up, bonds go down. So the value of your bonds go down when interest rates go up. When interest rates go down, bonds go up in value. That's why, since the 80s, interest rates have been going down for decades, and bonds have done a really good job of cushioning the blow of market crashes, because as interest rates go down, bonds go up in value. But we're now at a point where I think we all know we're at a point in this country where our interest rates are so low that there's really no place to go but up from here. Now, I could eat my words because we could always see negative interest rates in this country. Over 50% of countries overseas have seen negative interest rates where you're paying the bank to hold your money, but as opposed to earning interest, that is. But we'll have to see what happens. But bonds have been tough. But you've seen relative rotation graphs and how you can compare bonds over time. Look at that rotation. Kind of cool. But anyway, I looked at ETFs, international ETFs, commodities, individual stocks. So I think that's probably good for today. If you'd like to learn more about this, if you'd like to have your portfolio analyzed, thrown at an RRG chart just for fun, not that we would just do that on as a standard, but if that would be interesting to you, I'd be happy to run it through and just kind of show you what it looks like on paper. But I think that for today, anyhow, we'll end here. And be sure, though, to share this episode with your friends and family if you think they would benefit, if you think they'd enjoy this one. And if you'd like to discuss your personal situation further, not just having to do with relative rotation graphs and investments, but with financial planning, estate planning, retirement planning, planning for income after retirement, Social Security optimization, things like that, remember that you never have to be a client to ask a question. So if you'd like to set up an intro call with me, email us at info@libertaswealth.com or head over to our website at libertaswealth.com and you can send us a message there. Be the first to watch and listen to these episodes as well as our screencasts and other items that we send out by subscribing both to iTunes and YouTube. And don't forget, if you go to our website at libertaswealth.com, you can sign up for not only these updates, but also our other screencasts that we do separate from the podcast, as well as videos, articles, and other material delivered directly to your email inbox whenever they're released. Feel free to follow us on Facebook. I'm also on Twitter at Adam Koch, as well as Instagram at Financial Surgeon. And as I always say, there's thousands of podcasts out there, hundreds of thousands probably at this point. And you chose to give ours a listen today, so thank you so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koch. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.